Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim. It's the Friday special, I guess we can call this one.
Bob, you have questions from around the planet, so we'll first of all go take a question from Andre, a Charts and Markets subscriber, who says, "Hello, Bob. I listened to the podcast with you from March 13th. Thanks for recording it." He was arguing that we will enter a prolonged period of deflation. I was wondering why he sees gold and miners advancing. I thought this was a feature of reflation. Best regards, Andre in Zurich.
Yeah, Zurich's a lovely city. I've been there and enjoyed it. So
yes,
now,
it certainly is.
Yeah, it's a good question, and it takes a bit of thinking about it, and it's based upon gold's real price, where you deflate gold by the consumer price index inflation in the senior currency, which is the U.S. dollar. And it has a pattern. The real price goes down in the final years of a financial mania, which then makes the gold sector an underperformer, which it has been. But since 2018, gold's real price bottomed and has turned up and is very strong on the chart. But the way it works is that as gold's real price goes up, it reflects profitability improving for gold miners. And so it doesn't matter, like in the 1929, Homestake was the premier producer in the U.S. Its earnings were trashed because its costs were going up, and gold was fixed at $20.67 an ounce. And then the following 2 years, their earnings went up, by about 130%, and there was no change in the price of gold. But the cost of mining had crashed, so it was more profitable, and that's indeed the case. So you have to understand that you should be looking at the gold sector as an investment based upon improving internals for the industry, like better prices and better costs, and it doesn't rest upon the concept that gold's going to go to 10,000. You don't need the change in the dollar price of gold. You need the change in the real price of gold. So we're about to, the real price has been going up for more than a year, and that's all we need to know, and it's broken out on the chart, and it's likely to continue.
A question from Nathan. I would really like to hear from Bob about what he thinks of MMT. What is MMT, Bob?
Modern monetary theory.
Also, fiscal stimulus versus monetary stimulus. I just listened to a Canadian economist explaining that fiscal stimulus is the greatest thing since sliced bread. She was talking about basically direct cash injections to the general public, something like employment insurance, but with a full top-up. Other measures were government paying some people's mortgages, also infrastructure, spending, etc. She said this is what government money is for, and that we should not worry about the deficit and debt, because something like monetization of government debt. Anyway, they say it sounds like sorcery to them, and that's from Nathan.
Nathan, it is sorcery, and I've always interested when governments decide to do something in not forecasting the problem, then suddenly tout that they can fix the problem. And MMT, that's that modern monetary theory, which means just plain printing press operations. And that won't work. And fiscal stimulation means the government's going to spend your money, and that's a lot of nonsense. So, hey, an interesting question on some of the nonsense that stands for policy making.
From Ernie, the gold-silver ratio is now over 100, which is extreme. The RSI is also in the high 80s. Maybe explain again for us what an RSI is.
Relative Strength Index. It measures momentum.
Does this mean there's a major bottom in gold, silver, and miners?
Yeah. To be succinct about it, the gold-silver ratio goes up in a credit crisis. As a matter of fact, the gold-silver ratio gets volatile before a credit crisis, which it did in the last quarter. Then it starts to rise, which is it's a warning on pending financial crisis. And then it really moves. As we've seen this, the ratio, I think, we got 134 the other day. And last year sometime, just in order to emphasize that when we went into financial difficulties, that the ratio would make new highs, and just out of the thin air said 115. And at that, somewhere late in the year, some analysts were saying, the ratio is at 87. This is highly improbable. Therefore, you got to buy silver. The gold-silver ratio is a metallic credit spread. And when it goes up, it's like a normal credit spread's widening. And and the other thing ironical about gold pundits and silver pundits is that they think that the metals are being manipulated by governments. But when you look at the gold-silver ratio and when you look at gold's real price is deflated by the CPI, gold has been doing what it should be doing at the culmination of a boom, and silver has been doing what it should be doing. So if the conspirators have control of things, they're doing what they should be doing. Pardon me, I find it very amusing. But it's a good question.
We'll have more answers to questions to Bob Hoye right after this.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, we have a question from Goran. Goran wants to know what's Bob's views on currencies.
Yeah, that's a timely question, Goran. In a post-bubble contraction, the senior currency goes up. And that's what I've found and figured that out a long time ago, is the mechanism for that is in a boom, while everybody talks about the stock market, in a great bubble, you also have a huge speculation in debt items. And most of the new debt will be underwritten in the financial center, which is New York. And here's the killer part. Due and payable in senior currency units, which is the dollar, into New York. So all you have to have, sure, they've issued debt in Frankfurt and in London, Tokyo, etc., but all you need to have is a larger proportion of it issued in New York, in U.S. dollars, and that becomes then a huge short position, because then those who have to meet their interest payments and then also when the bonds mature, they have to pay them off, they have to surrender U.S. dollars. So that means they have to sell somebody else's currency, and they have to sell commodities or whatever they're selling in order to get their hands on dollars. So now, only in the last 2 weeks has this come out. People have some writers are suddenly discovering that really there's a huge shortage of dollars. So this is appropriate. This is why when on the gold side, we emphasize the real price of gold. And it's a good question.
From Kate, 2 gold bug questions for Bob. Silver fell this week to lows not seen since 2009. Is this the buying opportunity of a lifetime? Also in regard to the GDX, is there more downside? Could the January 2016 lows be tested for the gold mining sector? Thank you, Kate.
Yeah, very timely questions. First of all, as mentioned, silver, when it crashes relative to gold, it's saying that there's a financial disaster, which it is. And then, but within the financial disaster, the real price of gold goes up, which then makes gold mining more profitable, and then you get into a bull market for gold. Now, in knowing this, I'm been always quite indifferent to silver and silver stocks. But we're looking for now a tremendous bull market for gold shares on a rational basis. And the trick is that when you see falling knives, it's always tempted to try and grab them, but it's dangerous. So we have technical tools that are designed to give us what we call a downside capitulation or a sequential buy. If we get 2 of those together, that's getting pretty good timing. So that's what we will have, and people can check our website to get in touch with us for a subscription.
And a question from Andrew. It seems that once you take the liquidity out of the stock market, the major indices act more or less like penny stocks. Will the quantitative easing programs by central banks that are going into the bond markets and fiscal stimulus by governments eventually feed through to the stock market and eventually reduce the recently observed volatility?
When you're in a crash, volatility, thinness of markets is a problem, and it just has to wring itself out. I've got quotes from, like, in England with the 1825 bubble and crash. And by the way, all of the big bubbles have crashed in the fall of the year. The central bank, the Bank of England then, did provide all kinds of liquidity and did their best, and then at the end of it all believed that they had really stopped the crash from running forever. But crashes have similar characteristics, and although this one is not definitely a fall crash, but if you look at the worst declines in previous fall crashes, like, for example, RCA in 1929, Radio Corp of America, at its peak in early September, it was 114, and into the early October, it was down to 28. South Sea Company in 1720, at the 1st of October, the stock was 800. Sorry, 1st of September, the stock was at 800, and in early October, it was at 200. So the instruction from this is that mighty selling panics can last about, let's say, 2 months. And if you take the peak in the U.S. broad market in the middle of January, hey, we're getting close to 2 months. So somewhere out here in the next, don't know how many number of weeks, but then the entry point, like getting into the gold, any of these things will require really good technical research to back up your opinion that it's a good time to buy. So actually, while these things are hellish side, I really like the tools that we have for getting out and then getting back in.
And finally, we have a question from Cecil. With the GDX below 20, which is below its 200-day average, do you think a bottom is near in the mining stocks, or is there a long way to go? Do you have any targets for the GDX and S&P long term? And should people just step away from the markets for a few months? Thank you, says Cecil.
Yeah, Cecil, again, it's a very timely question, and we've sort of covered it. You can't look at price levels on the decline. What you look for is conditions in the market and when. So somewhere over the next 3, 4, 5 weeks, we will get a signal saying it's time to buy, and it probably will apply to gold stocks as well as the big market. And because it was an everything bubble except for gold. Lately it did, but everything got bubbled. Junk bonds, high grade bonds, treasuries, crude oil got bubbled. Credit spreads, everything got bubbled. And then we were looking for the everything correction with the possibility, and this was written in December and January, that it could lead to the everything collapse. And what happened is that the virus didn't cause, but it was a catalyst in a condition that was loaded and ready to collapse. So me, as being a financial and market historian, this is absolutely fascinating, and we'll watch and see how it plays out.
We'll have more with Bob Hoye right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, my question is, should governments be throwing all kinds of programs and equity, quantitative easing and so on at the markets right now, or is that just lost money? If you're going to inject funds, should you wait for a bottom?
Well, it's always been an appealing theory, and the idea that some super agency from somewhere can come in and in providing liquidity from thin air end a credit contraction. A British thinker, philosopher in 1622 published on that, and so it always comes out. But you should understand that a credit contraction is due to an overexpansion of credit against rising prices. And then when the prices stop going up, you start to unwind the whole thing, and the power shifts over from the supposedly with the central banks to definitely in the margin clerks' hands. And then as to, again, fiscal policy, which means government doing things, well, by the time they get around to doing it, it could be 2 quarters later. Then also overall, when a government is injecting credit into the markets, it's effectively risking taxpayers' money against a theory. And then when it is fiscal, like actually doing things, building bridges or digging holes or whatever, it's doing it with taxpayers' money. So this thing was widely discussed in the early 1930s contraction, and it's just a means using a crisis for the state to expand its power and increase its wealth, and it never works. The ideal thing is if when it gets over-speculated and you get a crash, it's those with real money will eventually take advantage of lower prices and lower wages and start to employ it wisely, whereas government is just all wasted. So no, financial stimulation and fiscal stimulation, forget it.
My question also, the U.S. going to zero interest rates, Canada near zero. How is that going to help out, or does it?
It doesn't help out. It's a consequence. And again, it shows how screwed up the mainstream theories are. And I'll just recite the theory, is that when it looks like the economy is going to go down, then the Fed will lower interest rates, and that'll keep the boom going. But if you look at 400 years of market history, you'll realize that interest rates, short-dated interest rates, such as Treasury bills, they go up in the boom, and they go down in the bust. It's as simple as that. And then I've done the work on the 1873, 1929, and 2007 bubbles. And the irony is that not only do the Treasury bill rates go down in anticipation of the contraction, the senior central bank, in which case the Federal Reserve, is behind, often 5 or 6 months behind the change, the decline in market rates of interest. So just to be clear on this one, Jim, there are market rates of interest such as T-bills. They trade all the time, 24 hours a day. And then there's what at the central bank, which is called the administered rate, that it thinks it is pushing the markets with. But believe me, they're trying to. They're thinking they can wag the tail and it'll wag the dog. So here we have it. The T-bill rate turned down. It reached its high, I think, in March, and when it started to turn down, and then in August, the Fed made its first rate cut, and that gain was a 4.5-month lag or something like that. So, no, the theory is that with a perfectly timed cut in the Fed rate, we'll keep a boom going, and the evidence is that interest rates going down short-dated says that the boom is over. And then the other irony is incredible. The faster the crash in the stock market, the faster the short rates come down. And we've gone from, at Christmas, the 3-month bill was at 1.59%, and now it's effectively zero. And it led the Fed moving. So, and also we should look into why the T-bill rate has come down. And it's very simple. Careful money around the world can tell when it's the top of a crazy bubble, and then it goes to the most liquid items, which is gold, and it is also short-term treasuries, like shorter than 1 year stuff in the U.S. So then the careful money goes and buys U.S. Treasury bills, which drives the rate down to zero, and then what happens is the Fed follows, trying to give the impression that the Fed is in charge. So it's one of the things, I mean, somebody wrote a poem in the early 1900s, and one of the lines is, how do you tell the difference between the dance and the dancer? It's very elusive stuff. So then when you've got market forces pushing down short rates, the Fed will follow. But then the Fed is trying to look like it's in charge. It's completely idiotic and wonderfully ironical at the same time. And this is what's been going on now. This is a very serious crash. And one can only conjecture that without the virus, it would have gone down anyways. And maybe a severe crash would have been in the fall. That's what we were looking for in January. So anyways, this is remarkable times, and the end, sure, we all want to kind of hope that it ends because it's nasty and ugly and unsettling, but there's no agency that can end it. It just, the selling exhausts itself, and again, our technical work will probably advise as to when the selling pressures are exhausting.
And finally, Bob, you found a headline that we'd like to investigate. In February 2018, U.S. Sold off its strategic oil reserves, the first time they did that in a non-emergency. But now they have started buying oil for their strategic reserve from small producers who will probably be hit hardest by this economic downturn. Your opinion on that?
Oh, yeah, this was a good one because back in February 18 was Trump saw the price rising and price of gasoline at the pumps was rising. So that was announced in February 2018. And then if you just look at the chart on crude price, April it was $65 and a high was in October at 77. So it would be an ideal time for that strategic reserve to be selling into a good market. And then now going the other way, it looks like a really terrific trade. So it crashes down into the 20s, and the Strategic Reserve has announced that it's going to be doing some buying. hey, as an old-time market person, it's terrific. So I like it. It makes sense. But it's not every government can do that kind of thing, because more than likely they would find an excuse to be buying when it was high. But, hey, it was an example of selling high and then buying low.
Bob, thank you so much for answering all those questions.
Thanks a lot there. Hey, we'll be looking forward to our next show.
If you're like Cecil or Kate or all the other people who send in questions, all you have to do is go to info@howstreet.com. You can find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.